Welcome back to BEM Academy. So far, we have covered what financial markets are and the three you'll actually trade. Today, we get into the mechanics. The three terms that define every single trade you ever place: pips, lots, and leverage. By the end of this video, you'll know exactly how much money is on the line when you click buy or sell. Let's dive in. 4 core ideas in several minutes. 1. What a pip is and why it matters. 2. How lot sizes work, from standard down to micro. 3. What leverage actually does to your money. And 4. How all three multiply together to determine your real risk per trade. Let's start with the smallest piece. A pip, short for percentage in point. It's the smallest standard unit of price movement in a forex pair. For most pairs, 1 pip is the 4th decimal place. Euro/USD moves from 1.0850 to 1.0851. That's 1 pip. The exception is any pair with the Japanese yen. For those, 1 pip is the 2nd decimal place. USD/JPY moving from 155.20 to 155.21. That's 1 pip. You'll also hear the word pipettes. That's just 1/10 of a pip, the 5th decimal place. Most platforms show prices with 5 decimals for precision. And next, lot sizes. The lot size is how much of a pair you're buying or selling. There are 4 standard sizes. A standard lot is 100,000 units of the base currency. A mini lot is 10,000. A micro lot is 1,000. And a nano lot is 100, though nano lots aren't offered everywhere. Bigger lot means bigger pip value. Bigger pip value means bigger profit or loss from every move. This is where it gets real. Pip value is how much money 1 pip is worth in your account. The formula is simple. Take the lot size, multiply by the pip, usually 0.0001, and you get the dollar value per pip. On Euro/USD, 1 standard lot equals $10 per pip. 1 mini lot equals $1 per pip. 1 micro lot equals 10 cents per pip. So a 50 pip move on a standard lot is $500. The same 50 pips on a micro lot is just $5. Same chart, very different stakes. Here's the cheat sheet you need to memorize. Euro/USD or any USD code pair, standard lot, $10 per pip. Mini lot, $1 per pip. Micro lot, 10 cents per pip. And nano lot, 1 cent. This is roughly true for any pair where the second currency is USD. For other pairs, the math is similar, but you'll need a calculator, or your broker will show it to you. And now, leverage. Leverage is the trader's secret weapon and the trader's most common cause of death. Leverage means using borrowed capital from your broker to control a much larger position than your own money would allow. A 1 to 100 leverage means for every dollar of your own, you can control $100 of position. With $10,000 of your money, you can open positions worth 1 million. Sounds great. Now, hear the catch. To open a leveraged position, you need to put up a margin, a small deposit that acts as a collateral. The required margin equals position size divided by leverage. So $100,000 position on 1 to 100 leverage requires only $1,000 of margin. That 1,000 is locked up by the broker until you close the trade. If your position moves against you and your remaining equity falls too low, you get a margin call. Your broker will close positions automatically to stop further losses. Here's the math nobody wants to teach you. Leverage multiplies your wins. It also multiplies your losses. In exactly the same way. If you control a $100,000 position with $1,000 of a margin, a 1% move in your favor doubles your money. A 1% move against you wipes it out completely. This is why around 90% of leveraged retail accounts blow up within the first 6 months. Leverage is not free money. it is borrowed risk. At BEM funding, you'll see leverage between 1 to 30 and 1 to 100, sometimes 1 to 50 for Forex and 1 to 20 for indices and commodities. Regulated brokers in Europe and the US offer 1 to 30. Offshore brokers may offer 1 to 500 or even 1 to 1000. But that doesn't mean you should use it. The smartest traders use only a fraction of the leverage available to them. Always. Here's how the three multiply together. Pip tells you the size of the price move. Lot tells you the size of your position. And leverage tells you how much capital is at stake versus what you actually put up. The real risk per trade comes from all three combined. A small lot at low leverage on a major pair, that's a careful, professional trade. A big lot at high leverage on a volatile pair, that's a coin flip you'll usually lose. Choose wisely. Now let's move on to the key takeaways. 5 things to take with you today. 1. A pip is the smallest standard price movement. The fourth decimal for most pairs, but second decimal for yen pairs. 2. Lot size determines how much each pip is worth. A standard lot equals $10 per pip on most pairs. 3. Leverage lets you control more than you own, both up and down. 4. Margin is the deposit you put up to use leverage. And finally, 5. Your real risk per trade comes from pip times lot times leverage. All three multiply. You now speak 3 most important words in trading: pips, lots, and leverage. In the next episode, we'll learn 2 more: spread and commissions. If you're ready to put up what you've learned into practice, BEM funding helps you do that. You take the trades, BEM takes the risks. I'll see you in episode 4. Take care.